Can we just talk about this natural sunlight? Like, yes.
Cause I ain't leaving alone. Feel like I could be honest, babe. We both know that we're grown. That's why I wanna know. How many drinks would it take you to be with me? Yeah, you look good and I got money, but I don't wanna waste my time.
Hi. Welcome to my bubble where we do a little bit of adulting, a little bit of healing, and a little bit of creating. We are adulting once again today. We are back with the newest addition to the financial literacy series. Today we are talking investing. My black folk always talk about that they're interested in investing, they want to get into it, but like don't know anything about it, don't know how, blah 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 blah. Now, there are multiple kinds of investing because you could have investment properties, you could have the stocks, bonds, options, like all those kinds of things. But most of the time, when people say investing, they're talking about stocks. So let's get into the important things for stocks and really what you should look at / consider when considering which stocks you want to buy. Let's get into it. So, the whole point of investing, right? When you're investing, I was going to say the whole point of finance, but like the whole point of investing is you want to buy low, sell high. Meaning what? Just like the reason businesses, right, when they're starting, like even just black owned businesses or whatever, they buy wholesale because if you buy a lot at once at a lower price, then they sell them on their website for higher than what they paid for each individual item, right? Buy low, sell high. So in the context of a stock, you would much rather buy a stock that is, say, $2 per share than a stock that's $15 per share. Because when the prices go up, say both stocks go up to $50 per share, you get more of a profit if you sell the ones that you bought for $2 per share than the ones you bought at 15. Granted, if they go up to $50, that's still a decent profit either way, but like perspective. You want $100 extra in your check or you want $25 extra in your check, you know? Buy low, sell high. That's the whole point. So if you're looking at a stock and whichever platform you use, right? You can use Yahoo Finance. I think that's a really good one. There's also, I discovered TradingView, but that one is a lot more advanced. That one has like the box plots and the box and whisker plots, and it can be a little bit intimidating if you don't know what you're looking at, and very much gives like, not gives Forex, but like Forex uses box and whisker plots for their activities. So like off rip, you might see that and be like, nope, it's a scam. But it's not a scam. It's a graph that represents certain things, certain numerical data for the stock. But we'll get into that. So say you're on Yahoo Finance or whichever platform you're on looking at stocks, right? You may see not recommendation, but you may see something somewhere that says bullish or bearish. These are kind of sort of predictions on the stock. If a stock is listed as bullish, that means the stock price is expected to go up, and if it's listed as bearish, the stock price is expected to go down. So if it's listed as bearish, maybe you keep an eye on it so that when it does go down, you buy more. So when it goes back up, you can have it as a profit. Or if it's listed as bullish, that means you might want to buy it right now because it's going to cost more later. Okay? That's simple basics as far as bullish, bearish. So it's kind of not so much a recommendation as much as it is a forecast, more so. So now there's a couple different ratios that will, one, be presented to you, and two, that you should pay attention to when deciding which stocks to buy. There's the working capital ratio, the quick ratio, or like the acid test. Not that you know what that means, but we'll get there. EPS, which is earnings per share. The price earnings ratio is going to be like P/E. The debt to equity ratio, the return on equity, well, yeah, and the return on equity. I'm also going to tell you what beta means, but it doesn't necessarily have to sway your decision. So let's go one by one. If you're looking at the working capital ratio, that that's basically a ratio that's helpful in determining the liquidity of the company. And liquidity is basically just how fast a company can turn their assets into cash, like enable, in theory, to be able to pay their short-term liabilities. I'm like using my hands down here, but you can't see because they're on my knees. I almost said heels. Jesus. Right? So liquidity is just how fast they can turn their assets into cash. Cool. Because they have things that they got to pay for. They need cash sometimes. Cool. Got it. Now, the working capital ratio is the difference between current assets and current liabilities. You got to divide them though. You got to divide current assets by current liabilities. That will give you the working capital ratio, excuse me. If you divide the two numbers and your answer is 2 or more, that's a healthy liquidity. It means they're very good at turning their assets into cash. They're covered and able to pay all of their short-term liabilities. Love it. Means, which in layman's terms means they're less likely to go bankrupt, basically. Not less likely, but like based on how they've been performing, it's not likely that they will go bankrupt because they're able to pay all of their debts. Working capital ratio. Now, the quick ratio, aka the acid test, is also a measure of liquidity. It is current assets minus inventory minus prepaid expenses divided by current liabilities. Now, most of the time, you remove inventory from the equation because inventory takes time to turn into cash. It takes time to sell the inventory and get the profit from it, you know? So say you have 8 million in assets, you have 2 million in inventory / prepaid expenses, right? And you have 4 million in liabilities. You would do 8 minus 2 divided by 4, which would give you 1.5. So your quick ratio would be 1.5. Meaning what? If you do the math and your ratio at the end is less than 1, that means that the company does not have enough liquid assets to pay their liabilities. So, to keep the same analogy, not that they're currently not in debt, not that they're currently bankrupt, but like it's not a good presentation. Like it's like they're currently bouncing back and forth, and that's not something you would want to get into if your goal in investing is to earn money. Consider it like they're living paycheck to paycheck, right? It's like as soon as that debt is due, that payment needs to come out of their next set of inventory. They're very like playing keep up. Think about it like that. That's if the ratio comes out to less than 1. Next one, earnings per share, or your EPS ratio, is basically you're referencing the future earnings of the company, which future earnings you as a shareholder would look at that as the risk of loss, right? The EPS ratio is a measure of profitability, and it like helps you understand how valuable that company is, right? So to find the earnings per share, you do net income divided by the weighted average of the number of common shares. If that number comes out to 0 or it has a negative earnings, that means the company, there's a loss. Like you're going to put all this money in, but you're not going to get a dividend, or you're not going to get money back. So reverse, basically, when looking at the EPS score, the greater the EPS score, the greater value of the company and the better idea it is. Earnings per share. What are you going to earn for each share that you possess, basically. Greater the EPS, greater the value, greater the company's value. Then you have price earnings, P/E. Thank you. What that was. Anyway, you have the price earnings, right? P/E basically is the company's potential for growth. And it's how much a person would be willing to pay in order to receive $1 dividend. A dividend is the money that a company pays back to their shareholders. So I'm willing to pay $5 for this stock in order to get $1 back, basically. That's if I own one share in a company, right? So people used the price earnings ratio to compare the potential value in different, amongst different stocks. The relationship of stock price to the earnings per share is part of the stock selection, basically. So a low price earnings ratio means that the company is undervalued and maybe it's worth buying, or a low price earnings could mean that the company is not financially healthy. Now, depending on how the rest of the ratios look and the risks that you're willing to take, if there's a low price earnings, maybe you still buy it. That's up to you. Now, a high price earnings ratio means it's an expensive stock, but maybe the stock is expensive because the company is doing so well. You got to spend money to make money in anything finance related. So, yeah, the stock, because everyone also automatically thinks Apple, Nike, all of these stocks are $200, $400, those kinds of things. So it's like, yeah, the stock is expensive, but how much money does Apple make? How much money does Nike make? I'm not sure that those companies pay dividends. I'm sure they do, but it's not much. But either way, you're getting a return on your investment. And then the more stocks you own, the more dividend you get. So it's up to you. To calculate the price earnings, you divide the current stock price by the earnings per share. So say a stock's closing price for the day is $46.51. Say the earnings per share for a 12-month period is $4.90. So you divide the two, you get a price earnings of round up 9.5. Okay, so that means the investors are willing to spend $9.50 to receive just $1 back as a dividend. Now, depending on the investor, some investors are willing to pay 20 times whatever the price earnings is, just because they expect that much more return on their investment. It depends on what kind of investor you are, what kind of risk you're willing to take, basically. First of all, the puff is puffing. You see her? But also, it's because my hair is dry. So it's not because my hair, whatever. Moving on. Say the website or whatever does the math and the price earnings is 0 or becomes negative, it's going to show as N/A because it's no longer applicable, because you can't pay $0 and get stuff back, or you can't, you can't take from them and get stuff back, so it's not applicable. Next ratio, debt to equity. The debt to equity ratio is basically how much of the company's funding is debt related or like borrowed from others. Debt to equity basically says if the company was to make zero money in revenue and in sales and whatever, right? Would the company be able to pay all of their debts, all of their outstanding debts with just the money that they receive from investors? That's basically what that means. So when looking at the debt equity ratio, you use that to compare the leverage between different companies in the industry, right? Because you could be looking in the tech industry, you could be looking in the nursing industry, you can be looking in the weed industry, right? So you compare the different companies to the industry as a whole, right? And when you're comparing the debt to equity ratio amongst other companies in that same industry, it helps you determine which companies are low or lower risk. Like say you were to put them all in one list, it's like these are low risk, these are high risk, just based on debt to equity, excuse me. And then if you want to know the calculation for that, to do debt to equity, you just divide the total liabilities by the total equity. Cool. So now the return on equity is normally a percentage, and the return on equity basically tells you how profitable a company is, or a company's ability to turn shareholder money into profit. Okay? Because, you're putting all this money into a company expecting money back, right? No matter how, like, whether you're expecting $50 or $1 back, you're expecting money back, right? Return on equity. That says, so that's not so much, you would look at return on investment, because that's how much money you're getting back for the money that you invested. But the company is doing return on equity, meaning, are we able to take this money that they're giving us and produce a profit with that? So the calculation would be net income, which is your income minus your expenses and taxes. Well, a company's, right, will be the income minus expenses and taxes. So net income divided by total shareholder equity. Now, in terms of the percentage, the higher the ROE, the better, because that means that the company creates a lot of profit based on the equity that they receive from their shareholders. If you're looking at a stock over time, because say Yahoo Finance, really on any finance thing you look at, there are different time settings. The graph will show from 1 day, 5 days, 1 month, 3 months, 6 months, a year, 5 years. Or you could look at all of the data for as long as the company has been public, not active, public. So in reference to ROE, you would want to see this number constantly increasing in the graph. So those are all the important ratios that you should look at when considering which stocks you want to buy, what you want to take part in, blah, blah, blah. Now, one of the other things that you might see listed among the numbers is beta. Now, beta measures the expected stock movement related to how the market is moving, right? So if beta is listed as more than 1, as greater than 1, that stock is more volatile, more risky than the rest of the market is. But if it's less than 1, it's not as volatile. So it doesn't constantly go up and down. It's more steady, right? Which again, that really just measures, or that it would really just be, that number will tell you this is a risky stock, it's not a risky stock. If it's risky, do you take the risk on buying that stock? If it's not risk, or if it's less risky compared to the market, then you should be in a good spot. But just because it's less risky doesn't mean things will not go wrong. It just means they don't expect things to go wrong. No, rephrase. That just means based on its previous activity, the stock is not expected to like crash or anything. But yeah, that's really it as far as basic investing. Hold on. A few simple ratios that you can look at and things to consider, and basically what all of that means if you are deciding to get into stocks. Now, the box and whisker plots will look more something like this, right? Now, the average person will be like, what the hell is this? I don't know what this means. So I'm going to tell you. Box and whisker plots are basically a visual representation of the numerical data related to the stock, right? So it's just a rectangle with 2 lines sticking out from either end. The rectangle itself represents the middle 50% of data. And then the upper line is the 75th percentile. The lower line is the 25th percentile. So if you've ever seen, like, not a parabola, but if you've ever seen, is that what they're called? I don't even remember. But you know, any regular graph, it'll separate them. Like, these are the lower numbers, these are the higher. Say you look up, you're on salary.com and you're looking up salaries for whatever position. It's going to pull up a graph, but it's going to give you your salary, the salary that you should expect based on the middle 50%. But it will also show you, there are some above that and there are some below that. It's basically what this is, just not in a graph. It's in a line. So the lines across the rectangle, I don't want to say the middle, but you would want it to be in the middle. The lines across the rectangle represent the median value. You were in school, you know what the median is. Now the whiskers, the upper and lower lines, represent the minimum and maximum price. So if a stock was its lowest time, the lowest the stock has ever been was $2, but the highest the stock has ever been was $25. But mostly 50% of the time it's anywhere between $8 and $17. The box would be 8 to 17. The lower whisker would end at 2. The highest whisker would end at 25. That's what that means. Now, if there are outliers present, then normally the whiskers will extend to 1.5 times the middle range, but that's a whole other different thing. Doesn't really matter. But that's just what this graph represents. It's just a visual representation of how the stock moves. This is a basic picture, but like, say if you go on TradingView, this is what you will see. This is the actual, as you can see, it's a screenshot from the website. This is just one of the lead stocks that I looked up. I didn't actually intend on looking up this one, but they acquired one of the other stocks I was keeping track of, so I looked up this one. See, now this is more of, I don't know anything about Forex. I never took part. I know some people who did, but I never watched one of the presentations or whatever. But I believe my mom was looking, I don't know for sure that she was looking at Forex, but one time I walked into her room and she's looking at a screen that looks just like this. And I'm like, oh, I know what all that is. Right? So don't get freaked out by this. Now you know what all of these numbers mean. Now you know what all of these boxes and all these lines and things mean. And that's how you keep track. That's it. That's the basics on investing. Those are a few ratios that you can look at and pay attention to if you want to get into investing, and ratios to look at to help you determine if that's a stock that you actually want to invest in. Yeah. If you made it to the end of the video and you don't know me, hi. My name's Naori. Stick around. You love it here. Duh. Embrace being a star. Subscribe. Follow my socials. It's No Excuses November. We're pushing out content. The financial literacy series will continue. There will be an episode. Yeah, let's call it that. There will be an episode on options, and there's an episode on calls and puts, and all that's coming later. We've already done how to budget and something else. I don't remember. I'm not gonna lie. But if you want to increase your financial literacy, can't speak English. You can please feel free to watch the rest of the series. Anyway, I'll see y'all in my next video. Bye.